chatting about it, then we've got ethics and planning to do. So what are we doing today, Vicky? Take us through.
Cool. So very, very briefly, we've got just a very quick case study recap. So hopefully everyone is familiar with the Simpsons family group that we've been working through the past few weeks, but just in case you've forgotten, we will just go through which one we're going to tackle this week. Then we're going to work through a bit of Trust 101. So like I said before, so if it's your first time, there might be a lot of new terms and concepts that you might need to get your head around. Hopefully we'll go slow enough, but if there's anything that you want clarified, just let us know in the Q&A box. So there's a whole list of different things there, and then we're going to touch on distribution resolutions and streaming, because we will need to know what that is and what that means for when we tackle the source documents and the tax record tax return on Thursday, as well as a little bit on what family trust elections are. So there's some pros and cons of making whatever that election is, and then we'll also touch a little bit on what you need to do if you want to vary or revoke a family trust election or an interposed entity election. But there's some more high-level stuff that we'll sprinkle in there just so that you become aware of certain things, especially in recent times. There's been a lot of developments in relation to trust, but some things might not be relevant or applicable for our case study. So we'll try to keep it basic as well, so you are comfortable preparing a basic tax return at the end of this. And then of course on Thursday I will hopefully teach you how to read an annual tax statement from a managed portfolio. So if you have clients just chuck a bunch of money into a investment portfolio that someone else just handles, that comes back at the end of every year, and it looks different for every different company, but they should have similar information, just presented very differently. I'll teach you how to pick up which numbers to use and how it ties into financial tax return and the tax rec. And then finally, we'll wrap it all up. So we'll look at the Homer Family Trust tax rec and tax return, as well as we need to circle back to Homer and Marge's tax return as well, because as we know, they should be receiving trust distribution. So that was the final piece of the puzzle that we are waiting on to wrap up their tax return as well. Speaking of which, just a very, very quick recap of the case study. So we already worked through Homer and Marge, most of the elements of the tax return. Third week, we did the Simpsons Lawyers Partnership, which was the legal firm with Lisa and Maggie. And then last week we did Boards by Bart, which was Bart's skateboard manufacturing company. And we have to know that that company is owned 100% by the Homer Family Trust, which is the subject of this week's unit. And we also need to remember that a family trust election was made in 2015 in the family trust, and the specified individual is Homer. So keep those terms in mind and those facts in mind, because we'll need to remember them throughout this week. Homer also has an investment portfolio. It's got some managed funds and ASX listed shares. I believe it's just Westpac shares. So when you see the financials on Thursday, you'll see that. So there's some income received from various sources, and we'll figure out what to do with them then. Okie dokie, over to you, Lisa, to take us through some Trust 101.
Thanks, Vicky. Yeah, I think one of those things, trust, a lot of you probably have already touched on trust. Maybe you've done a few trust returns. So some of these terms that we're going to talk about, you might have heard, but you don't really know what they mean. So hopefully we're going to unravel the onion a little bit, take the layers off the onion a bit to sort of fill in the gaps a little bit. And also, there's a lot of really technical things with trusts as well, and we'll touch on some of them, but we're not going to go into enough depth for you to really understand it well. Okay, someone's talked about deceased estates. We've got a slide on deceased estates, but we're not doing a deceased estate tax return. Bradley's asked about TB statements, which is quite topical at the moment. We'll touch on that on Thursday, Brad, because what we'll do is we'll look at when we have to fill in the beneficiary statement. That's a disclosure we need to make. So we'll address that now. So we're trying to get into, or just address that then. We're going to try and get into the theory behind it, so you know sort of what you're doing by filling in the tax returns. And yeah, just trying to unravel things. So again, this will give you an opportunity to go, I've done it for a few years maybe, but I didn't realise what I was doing. And that's what we're trying to achieve by today. And yes, no onions have been harmed at all, but we're trying to definitely, bit of a Shrek fan maybe, Vicky, is what I've said with the onions. I think, isn't that from Shrek or Donkey or something? So what is a trust? Now remember, it's not a separate legal entity. The only two entities that pay tax are individuals and companies. They're the legal entities that we've already covered from. So either for common law or tax purposes, it's not a separate legal entity. It's a relationship. Okay? And this is all about the relationship between the property, the trustees who benefit from it, the beneficiaries, and state-based laws prevent trust from living in perpetuity, in other words, living forever. As long as you keep paying your ASIC fee, your company continue on forever, but trusts have a specific vesting date, and there's rules about royalty and things like that, but it's usually about 80 years, and we'll just touch on that. So vesting is finishing the trust, right? Like deregistering a company. So again, we've got a whole different vocabulary that you need to understand, but we'll try and link it back, won't we, Vic? We'll try and link it back to things that you know. So in tax law, a trust estate is recognised as a notional separate entity. This means trusts are treated as taxpayers for tax administration purposes. So think about what the trust is doing. Homer is an investment trust, but you could be having businesses run through trusts as well. Of course, you're allowed to run a business through a trust. And a bit like a partnership, you fill in a partnership return to tell the ATO who's getting the money from the partner's point of view. You fill in a trust return so you tell the ATO who the beneficiaries are that have to put it in their tax return. So think about it as a disclosure document to some extent. So you've got to get your disclosures right. Now, just like partnerships, trusts are a flow-through entity. Everything flows through. It retains its character is what we mean. So if it comes in foreign, it goes out foreign. If it comes in passive, it comes out passive. If it comes in as a capital gain, or if there's a capital gain in the trust property, it comes out as a capital gain. They're the kind of things that we need to be aware of. So when you hear the term streaming, that's why we have streaming, because you can stream particular things because it retains its character because of the flow-through nature. So you can't park income in a trust, okay? Everything's got to come out, and that can be delightful, or that can be a pain. So in a company, we can park it and pay tax at 25 or 30%, as we discussed last week. With a trust, it's all got to come out. So there's different types of trusts as well. Discretionary are the ones we probably know and love, or maybe we don't love them, but we know, right? Discretionary is what we've got, discretion. In other words, you can do whatever you like, in effect. There's a lot of discretion with them, which can be good and bad. You're in the driver's seat. You're driving the bus, or the trustee is, for discretionary trust. You've got a fixed trust, which is a fixed share. You've got a unit trust, which is a fixed share based on units. And I think I mentioned this quickly last week as well. Think about a unit trust as a fixed trust, a bit like a company. Company has shares, unit trust has units. It's fairly similar. And we've got one slide on the watch out for unit trusts as well. So again, we're trying to give you a bit of a taster of the things to watch out for without teaching you everything, because we can't in the 2 hours we're talking today. Testamentary trusts and deceased estates, as it sounds like, it's about someone who's passed away. And we've got court orders, like bankrupt estates. So we've got trusts that have been set up by the courts and the judges. So they're the kind of different ones we've got. And if you hear the term inter vivos, we're saying that means that the trust was established during someone's lifetime. Okay, and sometimes we see that when we have to do beneficiary statements, and we'll have a look at that on Thursday as well. So those common types of trusts are discretionary trusts. That's what I said. These are our common bread and butter ones that we do a lot as practitioners. They sometimes get called family trusts because they're to do with family wealth, but it's not really a family trust because it isn't anything more. You can call a trust whatever you like. It doesn't even have to be unique. Vicky and I could both have a trust called Nuggets Trust. We're allowed to do that. Okay, that is not the unique stuff. It doesn't. With a company name, it has to be unique. So if you try and register a company, it always says, "I'm going to check the availability." With a trust, you can call it exactly the same. Everyone can have ABC Trust. Okay, so there's no defined entitlements. It's just a mere expectancy tendency that it's going to be to do with family. Even your trust deed that we get to might not have anything to do with family in it. We just assume discretionary trusts are family trusts, and we've just a bit laxed with the way that we define them. Unit trusts. These trusts have units. The entitlements are fixed based on a fixed holding. Okay, so that's what you've got. So you've got, if you hold a unit, you're going to get a fixed distribution, things like that, a fixed holding, a bit like a share in a company. And then these were really popular a little while ago. When were these set up? Probably about 15 years ago. You find there's a lot of hybrid trusts where it's a combination of discretionary and unit. So you can give income to some discretionary beneficiaries, and you've got some unit holders as well, and it gives you ultimate flexibility, perhaps. Or does it just add more complexity? I don't like them because most of the time it defaults to a unit trust anyway, but it gives you that extra element that you can distribute to whomever the eligible beneficiaries are. So I've used a few terms, so let's just define them. The settlor, here we go, with a nice flipped hairdo. It is common for the client to name their accountant as the settlor. So what is the settlor? The person is responsible for setting up the trust and naming the trustee and the beneficiaries. A settled sum must pass from the settlor to the trustee. So the settlor sets it up and then gives the $10. Yeah? So that's how it works, or whatever the settled sum is. This shows the exchange of the assets to be held on the trust by the trustee. And the settlor cannot be a beneficiary of the trust, otherwise there's no trust. Alright, so the settled sum, if you want to do an analogy, the settled sum should show up like an equity. Even though there's no equity in your trust, but you get my drift, right? You should see the settled sum. $10 at bank, or in folder, or petty cash, or whatever, and there should be a balancing as a settled sum. A lot of times it's $10, $50. If you go to one of the Queensland setups, they put the $10 in there, and it's actually a note. And I know some people, if they need petty cash, they'll grab all the money and then put it all back in again if they need it. So they use it a bit like a piggy bank, but I'm just joking. You should never do that. Is everyone good what the settlor is? So that's the person that sets it up, and as I said, it's usually us. We're the settlor when we do it. Then we've got the appointer or the guardian. Now, what's that? Now, you don't have to have one, but if it's mentioned, appointer or guardian, either of those two terms, this person has the power to appoint and remove the trustees. This is the most important role, because this person has the ultimate power. The kingmaker is the appointer and the guardian, or the guardian, okay? Now, if it's silent, you need to have a look at what we call the trustee, which is the rules of the trust, to go, how do I change the trustee? But this person has a lot of power. Clients say to me, Lisa, who should I make this? And I go, it's the richest person that you trust, is what I say to people. I've got no idea. Do not give advice on this. You don't know how truthful people are. So what are the elements of the trust? We've talked about trustees. The trustee can be a company or a natural person. Remember, it's got to be the legal owner. Remember how we said trusts and partnerships are not legal entities? Okay? It's only us being an individual or a company is, and they're the ones that pay the tax. So the trustee has to be one or the other. They're the legal owner of the trust property. Legal owner. Then we've got the trust property, money bags, houses, whatever. Oh. And then we've got the beneficiaries. Okay? Trustee, trust, we usually draw them as a triangle. The trust property's in the trust. So the trustee looks after the trust property for the benefit of the beneficiaries. So the trustee has an obligation to deal with the trust property for the benefit of the beneficiary with the terms of the trust. Which is written in the trustee. Okay? So that's what we've got. Everyone following all the different parties? We're all good so far. All right. There we go, Vicky. We're going to do a few little pop quizzes now just to make sure we cement the fundamentals, because this is so important, everyone, that you know So, Vicky, we got who's the legal owner of the trust property? Are we good? We got your voice on? Yeah, that's right.
A bit to unmute my mouth.
That's all right.
Again.
No, I thought I'd
Right.
get
Slido quiz. So first one of the session, and we've got 3 back to back, just to quickly test and wake you guys up. So we've got the QR code on the screen. Otherwise, this is Nugget has popped the link in the chat as well. So you can just keep the tab open because it'll refresh as we go along. All the questions just pop up as we refresh them. So first question: who is the legal owner of the property of the trust? So we just covered a little bit about trust property on the previous slide. So options you've got are number 1, the trust itself. Number 2, the trustee. Number 3, the beneficiaries. Number 4, the settlor. And number 5, the appointor. So again, I'm going to aim for my 50 today. Oh, we got there real quick.
Yeah, I
Thank
thought
you,
so.
everyone.
Really
Don't have to
emphasised.
push people for this one.
Yeah,
Right, let's see. Yes, it's the trustee who's the legal.
really important. And again, you should now know what all these terms mean. You should be really comfortable what the terms mean, who they could be, and what their role is.
Yeah, and the reason why we ask this is I think a lot of newbies get really confused when they see documents relating to trusts because even for example when you log into is it called online services for agents?
But all in the portal still, I'm old
The
fashioned.
portal? Okay, cool.
Officer.
The portal, the pothole, whatever you want to call
Yeah,
it.
the officer.
Sometimes you'll see the taxpayers called the trustee for like the Nuggets Trust instead of just the Nuggets Trust. And then when you see maybe you pull up like a land title search, it will actually not say the Nuggets Trust. It will say Lisa or the trustee for the Nuggets Trust or something.
ATM as trustee
Yeah.
for. Yeah, so just know who the legal owner is. Right, and think about it as well. If you've got a trust that's operating a business and they want to buy a motor vehicle, who's on the title? Who's on the rego? They're the kind of things you've got to feel comfortable with, because that's when it gets a little bit confusing for us sometimes. Okay, so make sure you're comfortable. All right, we got some
Yeah.
more.
Yep, and I'll say another point of confusion is especially when there are individual trustees and it's not clear in the documents, like they don't say as trustee for in the brackets or ETF in brackets. People get confused whether it belongs to the actual individual or trust. So make sure you know your client's structures well enough.
Yeah.
Next question: can a person or entity be the trustee of multiple trusts? Yes or no? Should be pretty straightforward. So if you just joined us in the last minute, QR code's on the screen, otherwise the link is also in the chat. So can I be the trustee of Nugget 1 Trust, Nugget 2 Trust, Nugget 3 Trust, Nugget 4 Trust? If I make up a company, can that company be the trustee? That's a different question.
No, no, it's a different. As I said, this is not a should question. This is can.
Yeah. So can you be?
Yeah, Robert's
And-
picked up on my comment. Good on you, Robert.
Yeah. All right. So we got our
Yeah.
something people again.
Can
And
be. Because a lot of times you're an individual, so you can act
Yeah.
your own name, things like that. Should be is a different thing. It's always nice to keep them all discreet, but it happens, right? And if you got, yeah, I won't go into any more information, but yeah, it can. Look, it's not good. But if it's an individual, well, you're probably going to be, because you've also got your own entity to worry about.
yeah, I think my record for a client who had one trustee, it was like a corporate trustee. So they had a company, and I think they had 8 trusts under that one trustee when they came on board, and they started adding more and more. And we were like, please consider having another one because a lot of them were holding property, so very high value stuff.
Yeah. So we're all talking about the corporate bail. All right, next one. What have we
Yeah.
got?
Speaking of which, this is the last question of the little lot, and then we'll keep going.
I'm gonna talk about
Can a trustee be held personally liable for the debts of the trust that they administer? Yes or no? So if Lisa comes to me and say, "Hey Vicky, can you hold this property in trust for me?" I'll be like, "Sure." And then there's all these things that need to be paid in relation to that property. Would I be on the hook for all those things? Yes or no?
And think about the previous question. So we've led you through, haven't we? The issue. So this is really highlighting. This has nothing to do with tax. This is just good because we usually set up these things for our clients. Whether we should or we shouldn't, don't go there, we usually do. Right? But as Robert put, it's not yes, but it's not recommended. Could be why. Yeah?
Yeah. Awesome. So let's see what people have said.
Yeah.
And it's yes. So I like to think of this kind of like directors as well in companies. Like we know that sometimes they'll get pinged for certain tax debts as well. So yes, in the similar vein, a trustee can be held personally liable for the debts of the trust that they administer. So it's a very, very serious role.
And think about your risk and liabilities of anything, even yourselves. I'm a big one about deceased estates and being executors of wills and things like that. Just you've got to understand your responsibilities and risks if you take on any sort of authority role with your clients or yourself or what you're suggesting to your clients. Because you're really stepping over that line of being the accountant to being the lawyer. And remember, we can't provide legal advice. So lots of things to do with trusts. I really find we're sitting on the fence a bit. Are we providing legal advice or not? And it really makes me feel a little bit uncomfortable because we're not covered. Right? Risk, responsibility, we're not covered providing legal advice. So if all of a sudden your client has a go at you and you've provided legal advice, there goes your public liability, there goes all your limited liability and all that sort of thing. Okay? So is it better to have a corporate trustee or an individual trustee? Up to you.
Depends.
Up to you, really. It depends. As we always say in tax, it depends. I like having the corporate trustee in there. Just an empty shell corporate trustee. You pay the money, you set up an empty trust, an empty company, right? I recommend a corporate trustee, and you really all it should cost you is what is it now? 300 and what's your ASIC fee a year? Whatever the ASIC fee a year is, it's more than 310, is it? It's gone up.
310. 321.
It's above 310 now. I can't remember what the next number is. It's 321. Thank you, Rabin. Yeah, Rabin said it's 321. I knew it was over 310. I've just seen 321. It always just goes up. It's going up higher than inflation in our wages. But I like the idea because remember we've got the corporate veil with a corporate trustee, so it sort of gives you a bit more protection than what an individual does. And think about it. If you want to change the trustee, remember about the role of the appointor. Changing the trustee, okay? You can change the shareholders and directors in the corporate trustee easier than changing the trustee itself, and you're getting the same outcome. So again, think about the role of the appointer, think about what it says, but there's usually nothing in a trustee that I've ever seen where you can't change the shareholding and the directors of the trustee company. It only talks about changing the trustee. Okay? It's corporate veil. Okay, so you can look up corporate veil Samir and look at that. That's more involved than that, but it does give you a bit more asset protection. All right. So, trust deed. This is the document for your trust. Okay? If you set up a company, you don't need a constitution because it's governed by corp law. Right? The Corps Act says what you can and can't do. You can use what you call your replacement rules. Go back and do your corpus law subject again if you don't know what I'm talking about, right? But you can do that. With the trust, this is the document and it's unique. You might use a boilerplate one, but it's still unique. Okay? The trust deed are the rules of the trust. It needs to be executed. You're better off doing it wet. The wet signature, not a digital signature. Although we're not sure exactly, I still think it's best to have a wet signature if there's any dispute. In certain states, it needs to be stamped. Victoria, it needs to be stamped. Queensland, it doesn't. You know what happens in your states, okay? This is the most important document, and we love, this is what we say, read the deed. You need to understand the trust deed for each one, okay? If you have a trust where you haven't cited a copy of the deed, go find one. If you've lost a deed, go see Andrew Henshaw from Velocity Legal or someone else, okay? You need to, okay, what to do if you've lost the deed. Because discretionary trusts are discretionary, So when things go bad, you need the trust deed. When things are good, no one cares about it, but things do go bad. Okay? So that's whether it's in a legal dispute with beneficiaries and trustees or the ATO. Everyone, if you get questions, this is the document that needs to be gold-plated, flood, fire, theft prevented. Okay? This is the document. And make sure you can see an executed copy and make sure it's been stamped if it needs to be stamped, like it's got Victorian. So yes, and we'll talk more about the trust deed, and Homer, we see a copy of the trust deed. So you know what you're looking for. So how is the trust taxed? Because it's a flow-through entity, so is the trust actually taxed? It's not a separate legal entity, but you've still got to lodge a tax return to basically tell the ATO who's who at the zoo. Okay? Who's going to get the money, or is there some reason why the trustee might have to pay tax? As Vicky alluded to with the online systems for agents or portal or whatever, when you look up in your portal and say the trustee for, that, all these sort of things, right, will be in the portal. On documents, it could be Vicky ATF as trustee for the Nuggets Family Trust, for example. All right, what have we got? We got Homer and Marge as trustee for the Homer Family Trust. Yeah? So you've got to work out what's on the legal documents and what it is. But notice it says the trustee for the trust. It's not the trust, the trustee for. So the net income or loss of the trust estate is your equation that you know. Derived trust income less incurred trust expenses. But it's called the net income or loss of the trust estate. Okay? But the trust itself does not pay any tax. Either the trustee pays the trustee pays the tax on behalf of the beneficiaries, or the beneficiaries pay the tax in their own tax return. In an ideal world where everything is done correctly and you've done your job or the trustee's done their job, and you don't have any foreigners getting any distributions and things like that, flows through. Trust is just a disclosure document, and the beneficiaries are just going to pay tax in their own tax return. Okay? So what happens is beneficiaries will be taxed on their share, providing that the beneficiaries have become presently entitled to the income. Okay? The trust is given money throughout the year, and then there's a true-up called present entitlement that says who's getting what. All right? Present entitlement. So we've now got another Slido just to be totally clear on how we've set things up. Okay? Think about what we've said so far, and this is one that I see wrong all the time. Vicky, go for it.
Alright, so again, QR code's on the screen, otherwise this is a nugget. Also pop the link in the chat for any latecomers. Question now is, who holds the TFN or the ABN for the trust? Option 1 is the settlor, the one who gives the $10 or $100. Option 2, the trustee, who we've just covered as the legal owner of all of the trust property. Number 3, the trust itself. Okay. Number 4, the beneficiaries. Okay. Number 5, trusts aren't entitled to a TFN or an ABN. Could be true. Could not be.
But think about it, those of you. I just wanted to highlight this because you see mistakes done all the time on this, or people go ballistic and TFN, ABN, every single thing in the thing. Every single entity they can think of, which then means we've got to do return not necessaries and things like that. Or what can happen is, Vicky, as we well know, that the taxpayer, the operator of the, can I call it this way, let's say this, the operator of the business might think they're operating in a trust, but they're actually operating through the corporate trustee, and I've seen that before as well.
Yes.
So we've got over our 50, so let's have a look at what people are saying. alluding to is if you've got a corporate trustee, sometimes they'll give that a TFN and an ABN, and it's not doing anything. It's the trust that's operating, right? So then you've got to go, oh, now I've got to lodge a return not necessary because that's meant to be an empty shell. That's your asset protection using a corporate trustee. It's just meant to sit there. It's not having an ABN. It's just sitting there with an ACN, right? That's all it's got. You just want to pay your ASIC fee and go for it. But sometimes what's happened is they've registered the TFN, the GST registration, the pay-as-you-go withholding registration and everything in the corporate trustee. So they think they're operating in a trust, but they're actually operating in the company. But sometimes it's very, very messy.
Xem
Just
hiểu không
think
tụi em?
about that.
Dạ có.
Alright? That's all I'll say. Remember, it's the trust itself. So the legal owner is the trustee. So that's on title. You buy a car in the business, it's the trustee that's got the...
Xem hiểu không?
Dạ có.
Hello.
Có chị.
Ờ,
Cái này
đúng
cũng
rồi.
là câu hôm trước em thắc mắc lúc mà lập mấy cái AVN các thứ
Đó,
ấy.
cho nên đó là em thấy đó là lý do tại sao em phải xem seminar.
Vâng.
Đúng chưa?
Vâng.
Mình xem đi và mình check nhau nhỉ.
Vâng.
registration as trustee for the trust. Okay, you buy property, it's the trustee, but it's the business is getting run out of the trust, so that's got the TFN and the ABN. Okay, I just wanted to be really clear on that because I see that done wrongly. Now, if it has been done wrongly, you just do a return not necessary. But if you're operating in a company and think they're operating in trust, then it's a whole different ball game. You've got to roll it over. You've got to roll it from a company to a trust or a trust to a company, depending on what you're going to do, and you've got to look at all the rollover relief. Beyond the scale of this, but just remember, everything can be fixed, but it's going to cost. Yeah, we can fix everything, it's going to cost. So the trustee doesn't usually pay tax on the trust income, and however, in what situations would they be taxed? Okay, I gave a few little hints, but we'll talk about that shortly. So in an ideal world, it shouldn't. Sometimes the design of the trust means that the trustee needs to pay tax on behalf of the beneficiary, and if your trustee is stuffed up, the trustee's paying the tax, and that's how I'll put it. The trustee, not us, the trustee is stuffed up. Okay, so what is income? Enjoy the ride, everyone. Let's see what we've got. So the income of the trust estate is accounting. Right? It's determined by the trustee. You need to work out what the income is. Or if it's silent. If they give no indication what the income of the trust estate is, the default is accounting. But as we know, because we've now done tax recs, and a lot of you have said, oh, I've never done a tax rec before, and now you know what a tax rec is, accounting and tax is sometimes different. So what's the income? Accounting or tax? Do you need to have a definition in the trust deed, which we call a tax equalisation clause, right, to say net income of the trust is defined in section 95(1) of the 36 Act. What that's saying is tax is the income of the trust estate. So net income and income of the trust estate are the same thing. Now, after this thing called Bamford, and if you live through Bamford, you'll know what I mean. Bamford. You hear it. If you want to sound intelligent with trusts, and they talk about some concept, you go, oh, that was in Bamford, because everything was in Bamford. It was a big case, and we talked, I don't even know what year Bamford was now. We're probably talking about 20 years ago, I would think now, Vicky, because we're all getting too long from that. A lot of trusts were amended to add in this tax equalisation clause in it, because otherwise you had to do some interesting machinations. But a lot of us still aren't not thinking that this is the panacea. This is not making everything in trust simple. If you try and make trusts too simple, you're probably going to make a mistake. Trusts are complicated, and it's the most complicated thing we do as a small business practitioner. I think aligned with small business CGT concessions, I think they're very complex as well. Okay, so just be wary of that. So the net income of the trust estate is the income for tax purposes. Notice how it's very similar. Let me just put net in front of it. So that's the taxable income. And trusts are taxed based on the residency of an individual trustee. Okay? So we prepare a trust tax return like they're resident and like they're an individual. Okay, that's the rules. Losses can be carried forward and offset against future income. And we touched a little bit on it last week with companies. There's some integrity provisions to make sure you can't use the losses if you're not entitled to it. You're not going to distribute losses to beneficiaries. If you made a loss in a partnership, go for it. Distribute the loss. But in a trust, you can't distribute losses. It gets trapped, and then you have to do some integrity provisions to see whether you can use them or not. Okay, so in that way, they're a little bit more like a company. So what do you do if your accounting and tax is different? And as we know, with tax regs, it happens. And how can they arise? Remember, we don't journal franking credits. What about the discount component of capital gains? If a trust retains its character because it's a flow through, and we tax a trust like it's an individual, it gets the 50% discount. So if you've got a capital gain of $100 and it can be distributed and it can be discounted to 50%, so $50, and you've got a tax equalisation clause to say book equals tax, and so you're going to distribute the $50, what happens to the other 50? You know what I mean? Like, there's not a great panacea with it all. And then we've got things like non-deductible expenditure, we've got asset reval reserves and all those sort of things. So you've really got to understand how the income is defined to work out what you're going to distribute to the beneficiaries as a trustee. And as I said, you're going to say, Lisa, what's best? It depends. But you've got to read the deed to work out what's going on. If there's no book-to-tax adjustment in the year you're doing, you're probably home and hosed. It is the simplest. But as soon as they've got some franking credits from an investment, like Boards for Bart and Homer, or if you've got a capital gain, that's when it starts. When those things start happening, you got to go, well, how does it all work? So let's explain what present entitlement is. And you've heard about this, so this is what's happening. The trustee of discretionary trust, and as I said, these are the ones we normally play with, discretionary trusts. Remember, with a unit trust, the present entitlement's fixed because there's a fixed entitlement based on the units. Okay? So the trustee of a discretionary trust has the discretion to pay or apply income of the trust for the benefit of the beneficiaries. And we do that through doing a trust distribution or a resolution. The royal we, meaning the trustee, that we assist as the practitioner, yeah? Payment or application of funds is made for the benefit of the beneficiaries. There is a vested indefeasible interest, not able to be lost. Okay, so you basically say, presently entitled, show me the money. Additionally, if there is presently entitled, the beneficiary can demand immediate payment. It does not mean the cash is paid. So you may have heard these things called UPEs, unpaid present entitlements. That's what they are. Show me the money. And we now know they're not alone, don't we, Vicky? I'll just throw that little bit of Bendel in. We know they're not alone, UPEs. But anyway, we'll just, someone's liked my laugh because you've followed Bendel. I don't think we'll touch on Bendel, but we'll touch on 100A. So 100A was flavour of the month. No change in law. The ATO just said, we're going to start looking at this very, very weird little section again, and we're going to start auditing against you. So you may have heard something called Section 100A. It's in the 36 Act. I'll do my joke again. All the bad stuff's in the 36 Act. Okay? And the law hadn't changed, but all of a sudden the ATO started producing all this guidance saying, oh, we're going to audit you 100A. We're going to audit you on 100A. So 100A, the fundamentals, and we're not going to go into too much detail, but let's just quickly run through it. It arises where there's a reimbursement agreement. So what we're saying occurs before a trustee has made the person presently entitled to the income of the trust, and the beneficiary agrees to direct the money somewhere else. Okay, so the money doesn't travel in the same way as what we've got. Okay, so a sneakiness with Section 108, it's an integrity provision. It's to stop you from doing things. So the idea is that you're going to give money to someone that's going to pay less tax, and you're going to get the benefit of the money. And the reimbursement aspect is you've arranged this before you've made the person presently entitled, right? So it's got to be a reimbursement to begin with. So if you followed some case law, a lot of it said, well, it's not a reimbursement. And there's other things with this Section 100A, but we won't go into too much detail. I just thought we'd touch on it because most people have heard about it. Now, if you want to get rid of Section 100A, make the money travel with the beneficiary. It's as simple as that. There's a number of times where the money hasn't travelled. Cut the checks, do the FPOS, whatever you need to do, right, to make the money travel. If you're going to make the money travel to a corporate trustee, or not a corporate trustee, a bucket company, a corporate beneficiary, I should say, a corporate beneficiary, a bucket company, make sure they've got a bank account for them to collect the money. Okay, a lot of times you see this corporate beneficiary not even having a bank account, and they go, well, how can the money travel? Okay, so that's the easiest way to get out of Section 100A, so you don't need to overthink it. All right, there's other ways as well, but if you do that and keep really good trust hygiene, as I call it, make the money travel. So you made someone presently entitled. I've made Vicky presently entitled for $100. Sometime in the next financial year, I've paid her $100. We're sweet. Right, that's the easiest way to get around it. So how is the trust taxed? Who pays the tax? So just look at it. We've had some comments in the chat, which is great. Individual resident beneficiary, that's just going to flow through and everyone's going to pay tax at their marginal rates. Okay? Individual non-resident beneficiary, we go, ooh, we better go and find them. Okay, so the distribution will be included in the assessable income of the beneficiary, but the trustee is liable to pay the tax at non-resident rates and must complete the tax return to reflect this. Okay, so if you've got a non-resident beneficiary, the trustee withholds the tax on behalf of the beneficiary. The beneficiary then needs to lodge the tax return. So think about it exactly the same as pay-as-you-go withholding. Yeah? That's who the responsibility. Employer pays it for the employee. Okay, so that's what happens. But it's not the trust paying the tax, it's the trustee paying it on behalf of the beneficiary. And if you're under legal disability, the same thing happens. Okay, you don't have the power to contract, which is what legal disability is. Under 18, mental handicapped individuals or undischarged bankrupts, again, those people still have to those beneficiaries still need to lodge a tax return, but the trustee has an obligation to withhold the tax, just like a pay-as-you-go withholding, because they don't have mental capacity to be able to do it, legal capacity to do it, or with the non-resident, we've got to go and find them. So it encourages them to lodge a tax return. See how there's a little bit of a nudge happening with this? Okay, what happens if there's no beneficiary present entitlement? Then the income is then treated as trustee income, and the trustee pays the tax at the top marginal rate. If that's the case, there's no CGT discount and there's no refundability of any franking credits. Everything is lost. So if there's no present entitlement, that's what happens. However, there's some trustees that have got default beneficiaries, and I love those. That's a safety net for us. A default beneficiary, if there's no present entitlement, it goes to the default. The default is usually the primary beneficiary anyway. So it's quite nice if all of a sudden there's a mistake. Okay? Not all deeds have it, but read the deed. If you check the trust deeds that you have and there's no default beneficiary, you can amend it all to put in a default beneficiary for your trustee. But just tell them if there's a little bit of a problem or something's gone wrong or they didn't do it right or they've made some sort of mistake once we get to doing the distributions. So that's when the trustee decides who the beneficiaries are. If there's any sort of mistake, the default beneficiary is just a little bit of a safety net that helps us out, which is pretty nice. So read the deed and see if there's a default beneficiary in them. But you remember we talked about Section 100A? If you get caught on Section 100A, default beneficiary clause is not going to help you. So don't think that's going to be a total get out of jail free card, coining monopoly. So once you've got a deceased estate, this is our only slide on deceased estates. I think we've only just got one little quick one on it with deceased estates. If the trust is a deceased estate, special rules apply. And it's a special sort of trust, okay? It's one of those interesting ones. You can have a testamentary trust, which talks about what the deceased estate's going to do to sort of not let everyone run through all the money that they're going to get from the deceased estate. But the deceased estate is basically set up pretty much through will, okay? Or if there's no will, we're all good. Intestate, it's just an artificially contrived trust. The trustee is usually the LPR, the legal personal representative, or the executor who administers the estate. Okay, so that's who's the trustee of it. So again, think about it, and this is one of the things that you need to work out as well when you go and see your clients when we talk about tax planning next week. Your client's got do you have a current will? Yeah. Do you have power of attorney? Yep. Who's the executor of your will? It's my eldest Phil. He's over in the UK. Could cause you some grief. Just putting it out there, and I'm not explaining it, but just remember that could cause you grief as well. Okay, because your trustee is the resident of your trust. Now, because there's a lot of argy-bargy, a lot of fighty, when someone dies, you've got a lot of emotion, and you've also got a lot of this money involved, and there could be a lot of money involved. Remember, the generation that we have now isn't as wealthy, not going to ever be as wealthy as the generation that is passing away now. So the money's going to transfer down to the next generation, and that's the money that they're going to pay off their mortgage with and all that sort of stuff. It can get really, really nasty. So because of that, our tax laws say you've got 3 years to sort it out. We'll give you 3 years to sort it out. And in that time, this trust works a little bit different. It acts like an individual. So it sort of steps into the shoes of the deceased. All right, so it's like the deceased has kept going for 3 years and it gets a tax-free threshold and all that sort of stuff. All right, but then the tax laws say after 3 years you should have sorted it out. And the reason for that's really important, and it's another one of these things where if you are getting involved in this, do some more CPD in deceased estates. It's really important. The responsibility on the executor or the LPR, the legal professional representative, they're taking on all responsibility for as the individual, lodging all the individual returns, all the responsibility for the deceased estate. If there's any debts owing to the deceased estates and the executors already distributed the money, they're going to be up for it personally. So again, there's a lot of issues with deceased estates that you really need to get your head around. Okay? After the 3 years, as we finish off with that one, it just reverts back to just a normal type trust. So you should have enough to worry about by then. If you can get everything sorted out quickly, you don't actually need to do a deceased estate trust return. You just need to put the money into the beneficiaries' individual tax returns. But that gives you a bit of an idea of how deceased estates work, because they are a trust. Beneficiaries can be made presently entitled to the income while the estate is being administered. and when it's fully administered. Okay, so they can get the money as they go. As I said, that's what we do. All right, flow through and capital gains tax. This is an interesting thing because remember, if it's capital gains, it's going to come out as capital gains. Right, so if they've had a CGT event in the trust, because they're flow through. So remember, it's going to retain its character. So trusts are eligible for the 50% discount because they are taxed like an individual. That's how our tax rules work for trusts. It says the residency of the trust is the residency of the trustee, and they're taxed like an individual. Even if you've got a corporate trustee, they're still taxed like an individual. Okay? So how does that work for the beneficiaries? The net capital gain, including the discount, is included in the trust tax return and distributed to the beneficiaries. The beneficiary receives the discounted CGT distribution, but it grosses it back up in their own tax return if they're eligible for it, if it's an individual. But they're going to gross it back up even if they're a corporate beneficiary. If the beneficiary has any capital losses in the current year, you're then going to take the losses off, and then if they're an individual, they can then take the 50% discount again. So because it's a flow through, the trustee may want to distribute capital gains to people that have got capital losses. You don't know. We've got a lot of options when it comes to the discretion of it all. What you've also got to look at is if the business is being operated through the trust and the business is going to close down and sell it, you've got goodwill and things like that, you may want to manage the small business CGT concessions for that client as well. If you do that, make sure that you plan for it. Okay? Because you need to look at different things and whether they're eligible. Again, beyond the scope of this course, it is quite complex. You might have heard what I said before was that's probably one of the hardest things we do as small practitioners doing small business CGT concessions. And sometimes, and the reason that it's really important as well, you're up for millions of dollars most of the time. Okay, so big ticket item, it's one of the biggest tax concessions the ATO monitor. Going, should we change the rules on this? Okay? So just be very, very wary of that and understand how the CGT discount works. So we distribute the discount, then in the hands of the beneficiary, we're going to gross it up and then deal with it like normal. Okay? You might say, why do we do that? Well, that's just the way the rules work. Okay? Remember, if the trust has an overall capital loss, you can't distribute it though. It'll need to be carried forward. And remember, capital losses can only be offset against capital gains. Revenue or tax losses can be offset against everything. Yeah? So you've just got to watch so we can't distribute the loss. Okay. Special consideration for unit trusts. Now this is the only time we're going to really, really isolate out unit trusts and just make sure you're very wary of it. Because again, unit trusts were really popular. You know how I said the hybrid trusts were popular about 20 years ago? So were sort of unit trusts. And for some reason, whoever was spouting this great idea, unit trusts usually had commercial properties in there. So think about it, you put a commercial property in the unit trust, and then the business rents the commercial property. You with me? The unit trust registered for GST because commercial rents, taxable supply, which about said GST-able taxable supply, you know how it all works, right? But you've got to watch out for this because if you've got a property in there, your book and tax is going to be a little bit different, isn't it? So what can happen is this special event CGT event E4. So CGT event E4 occurs when there's a capital payment for the trust interest. This might occur when the beneficiary receive a distribution of non-assessable amounts from the trust in which they hold units. The amounts reduce the unit's cost base. Okay? You with me? So you're going to distribute the accounting, but for tax, you've got non-assessable amounts. You've taken a deduction for something. From what we've talked about over the past couple of weeks, think about when that could unit cost base. If you get confused, just think about company share, unit trust units. Each one's got a cost base. So, you bought in at $10, $20. If it reduces to, it can only reduce down to nil if you get one of these non-assessable amounts. And anything, you can't make your cost base go negative. So that difference then is treated as CGT event E4, and you've got to pay a capital gain on it. All right, so just be wary of it. Now, this happens with Division 43 capital works deductions. That's where I see it all the time. Your 2.5%. This is what happens because, again, usually you've got a land, you've got a factory, you've got Div 43 deductions. So just be wary of that. If there's a difference between what's distributed for accounting purposes and what's distributed for tax, you could trigger this E4 because you can't let the cost base go down. You're going to do a cost base adjustment every time that's different. And this is where it comes from. Div 43, the CGT active asset discount, which is what you get if you apply the small business CGT concessions. Okay, there's a 50% active asset discount. So you get the 50% holding discount, then you get the 50% active asset discount on top of it. So if it's small business CGT concession, so you're only paying tax on 25%, not 50%, and any return of capital. So be very wary of this. This is another watch out. Okay, 50% discount is permitted on these gains. All right, it's only the extra one. But again, I see it all the time with the Div 43. So be very wary of that. And I think I've hit the mark, haven't I, Vicky?
Yeah, 1:30 pretty much on the dot.
I think I've hit right on the mark for our 5-minute break. So using trust losses. So remember last week when we were talking about the company, we have COT, continuity of ownership testing, business continuity testing being same or similar business test. That's the integrity provisions to say, hey, you can't trade in loss companies. Okay? But think about it with a trust. Who owns the trust assets? The trustee. The trustee can change, yeah. Does that trigger COT? That doesn't make sense. But we're looking at saying, well, the business that generated the losses should get to use the losses, or the beneficiaries should get to use the losses where they didn't get the distribution the previous year. Think about how that could potentially work with beneficiaries. So you can imagine that we have integrity provisions for losses as well as for companies. Companies is always a lot easier to understand, but think about who the beneficiaries are, and if they've got discretion, well, could that cause the losses not to be used? Okay, change of ownership in terms of shares, not getting a distribution one year compared to another. It's pretty similar. So this is the concepts of what we're looking at in terms of the loss testing for trusts. Because remember, we can't distribute it out. Remember, with a partnership, we can distribute the loss. With the trust, we can't distribute the loss. It gets trapped in there like a company does. So we've got to make sure that it makes sense that there's some integrity around using those losses. So for the discretionary trusts, we've got these things. The pattern of distributions test. And that's sort of what I was alluding to before. The same beneficiaries receive at least 50% of the income and capital in prior years. That's a little bit similar to COT, isn't it? Continuity of ownership testing. Yeah, so it's quite interesting that it's not the same, but it's similar. So unless you need to apply it, and hopefully you won't need to apply it, right? You need to go into the nitty-gritty of it all, but that gives you a bit of an idea. There's the control test as well. The same trustee controls it. Well, that's a little bit the same as COT as well, saying, the trustee, has that got control, or have you changed trustees, so you've had a change of control? Change of control, change of ownership. Again, it's similar to what we feel a bit more comfortable with companies, I think. And then you've got the income injection test, which is an interesting one. So has there been a scheme to push money into the company to soak up the losses? You think about it. Could you make the trust a beneficiary of another trust? Could we have a cascade deed of trust through a whole little lost trust because we've got all the discretion to do with what we like. Right? You have all these little snakes and ladders thing coming of all trusts. Right? So this is where another integrity provision goes. And all those you can sort of understand where they're coming from that way. If I just said those words, you go, oh, this just sounds like, I don't understand it. But if you bring back what we're trying to achieve by it all, you can sort of understand it a bit better so you know where the little tricks and traps are. So for unit trust, they're a discretionary trust because remember, we can control all that, not we, the royal we, the trustee can control that. I keep saying we because we help the trustees. You get what I'm talking about. All right? So we can control all that. And then for unit trust, there's the 50% stake test. And that sounded like COT to me. Yeah, continuity of ownership testing. This test is for any changes to the underlying ownership. Individuals must maybe obtained, directed on their own behalf, at least 50%, blah, 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 blah. We're going with it's COT. Yeah, for all extended purposes, it's COT. For widely held trust, there's a business continuity test that is similar to that of companies. Yeah, widely held. We haven't given you the definition of that, but we're just giving you an idea. So, got to be aware of it, is what we're saying. Trust losses, remember losses get trapped, what's going to happen? Now we're going to get to FTEs and family trust elections, and that's how we manage this usually. Okay? But if you've got a trust that hasn't got a family trust election and it's got a loss, you've got to go through these machinations. Yeah, and satisfy all those. As I said, we've just touched on it. We haven't gone into too much detail. Okay? Vesting the trust. Like deregistering in company, we call it vesting the trust. Trustees will specify a vesting date on which the trust must end. Remember, it's not in perpetuity as the word we use. It doesn't continue on and on and on forever, right? There's basically a predetermined date of death for a trust. The maximum life of a trust depends on a state-by-state basis, but it's usually 80 years. In some trusts, there's some King Charles George thing, something, somewhere date, and it's these are the older trusts, and I don't even have one in my portfolio, so it's not even registering what it is. But for those of you that know about it, it's those sort of things. What you've got to look at when you read the trust deed, and I've seen it happen because mistakes can get made, the vesting could be the same day as the incorporation date, because they've just made it the same way. I shouldn't say incorporation date. The vesting could be the same date as the execution of the trust deed. Let me be technically correct with that. Because they've just made a mistake. So just watch it, but have a look at the vesting date. And 80 years, sort of work backwards. So 80 years from today, what are we in 2025? We work back and go, it's probably when trust started to be a little bit popular as well. So you might have some vesting happening as well. And in your trust deed, it usually tells you what to do. The trust deed will give you all the instructions. Usually it's not possible in rare circumstances if you want to include it. When the trust is vested, the beneficiary's interest to the trust property become fixed, and it usually tells you which beneficiaries get the fixed entitlement as well. And this is in accordance with the rule of perpetuities, which prevents trust from existing forever. Now, if a fixed entitlement happens, it's starting to sound a little bit taxing points to me, and that's why we get a little bit worried with it all. So when a trust vests, most likely happens is it's got trust property, or the trustee owns a property, but you get my drift, trust property, and you've got to distribute it to the beneficiary. So there's usually taxing points as well, and sometimes there's stamp duty and there's other things like that as well. So you've got to watch about any little adjustments and things like that you make to the trust. Sometimes you might have heard as well resettlement. Sometimes you can trigger resettlement as well of a trust if you start fluffing around with trust deeds and things like that. You, as a practitioner, beneficiary and not a legal trust person should never amend a trust deed, even if you're going to cookie cutter something that someone else has done. Please don't do it. Okay? Go to a lawyer, pay. I mean, their hourly rates are not that much more than ours, trust me. Okay? No joke, no pun intended, but pun intended. Okay? Do that. Because if you get it wrong, usually you have some issues, and it's usually stamp duty and CGT taxing points that can cause a bit of grief. Alright, so just be very cautious when you're doing anything to fluff around, as I say, with a trust deed. Do it with a lawyer. Okay, so they were the two sort of special topics that we just wanted to touch on. What to deal with losses, but we haven't really explained it as much as what we could if we had more time, and what is vesting of the trust and what it means. And again, if you're going, oh, Lisa, I don't know the vesting date of my trust, go through them all and find the vesting date. And if there's no vesting date in it, count your 80 days, 80 years. Okay? Depending on what your state you're in. I think it's pretty much, I think the territory's got something different, but I think most of the states it is 80 years. Okay. What we do in June every year, distribution resolutions and streaming. This is what you need to know. Because remember, your discretionary trust is totally discretionary. You've got the rules of the trustee, and they're really, really vague and broad. So what do? These little things, our trust resolutions, are the things that tell us who gets what. I haven't touched it. Oh,
Is it not moving?
not moving. Can you move it for me, Beck? Somehow I've lost.
Oh, mine's not moving too. Assistant, I get help, please.
Oh no, we've lost our.
Mine hasn't disconnected though.
Mine hasn't disconnected either. I'm shocked I've got it. I'm just going to refresh it. See?
Oh no, there we go.
We got it? Good. Alright,
Someone's clicking. Might be assistant, I get.
let's try it. Okay, so distribution resolutions. What are they? Yes, I've got it back. Excellent. Let me just turn off my sleep again. My awake sleep on. Beautiful. Alright, so the trustee of a discretionary trust needs to make resolutions to, if they want to make beneficiaries specifically entitled to the income, okay? That's what we're going to do. We're going to make beneficiaries presently entitled. The trustee has got that role, right? They have the discretion for the discretionary trust. The requirements and powers of the trustee for making a trust distribution depend on the trust deed. So read the deed. So you've got to read the deed to work out what you could distribute, what is the bucket you've got, and then you've got to work out if it's capital, if it's income, if it's something else, who am I allowed to distribute to? I'm allowed to distribute to Vicky. I'm allowed to distribute to me. I'm allowed to distribute to the Red Cross. Okay? So read the deed is telling us everything that we need to know. And if it's silent, it then goes back to first principle. In any case, the resolution should be documented on or before the end of the relevant financial year, which is 30 June. Okay? You need to at least make the decision. I've got a slide on this, but you need to at least make the decision before 30 June, which you're allowed to document it afterwards. But usually we say our meeting in June every year saying, okay, who's getting what? You've got a fair idea. You can estimate what the net income of the trust estate is, right? Because that's what you're interested in, because that's what you're paying tax on, yeah? And you set it up and do it as percentage. Yeah, Vicky gets 50%, I get 50%, we're happy, yeah? If there's no resolution, there is no beneficiary just presently entitled to any share of the income of the trust estate, and the trustee is assessed on the income unless you've got a default beneficiary. And as I said, I'm a big fan of default beneficiaries because sometimes things happen, like floods, fire and famine. Yeah, things happen. And the ATO has a really good trustee checklist for making trust distributions. It all came out when they did all the Section 100A stuff. They're trying to help us out. They're going, we're going to order you under Section 100A, but here's a little checklist to try and help you out. So we're being nice on this hand, and then we're going to Rachel, well, if you don't do it, we're going to get you on it. So the trust deed for Homa Family Trust. It's in your materials. Have a look at the extract of the deed. It's a pretty easy one to read. We thought we'd be kind to you, but some of them are extremely difficult. And they're written on little parchments, and they're not even look like they've been written like they're typed on a typewriter. Alright? So in our one, our Homa one, it allows discretion of the trustee to do pretty much anything they want. And that's fairly common, I would say, fairly common. However, let me just touch on this little one, because we're running pretty well for time, so I'm just going to pad it a bit big. You've still got to look at the trustee in total if you're the trustee. Because there's a beautiful case called Owies case, which is the Victorian Supreme Court case, and I'll just touch on that said, what is the purpose of the trust, what it's meant to do? So you've got that overlaying on top of it. So what I'm saying is, even though our trust deed says that you can do whatever you want, and remember that the trustee's usually relying on us as practitioners to help them with these documents, you've also got to be aware of the purpose of the trust and if there's any reason the trust was set up. Because in the Owies case, it said the trust was specifically set up to help the kids that weren't as well off. So the distribution had to go to the poorer kids. And the poorer kids took them to court. Again, the trust deed is always important when it goes to court, or if the ATO asks about it. So just be very wary if you're helping your client too much with your trust deed.
Yeah. Lisa, do you want me to pull up the trust deed very quickly? I think we can spare like maybe 5 minutes just looking at
I think
we've got time.
Want to do it now? Yeah, that's what I thought. I just thought I'd mention that. If we're talking about it, I think we're good for time, I think, Vic.
Yeah. Sorry, it's not in this week's resource pack because I thought we would cover it in...
it isn't there yet. Sorry.
not next week's Thursday, but let's just look through quickly. So hopefully I have the right
Here
thing.
we go. It's done by our friends at Velocity Legal.
Yeah, awesome. So I've already stripped out like most of the pages out of this trustee because I didn't want us to get distracted by all the other clauses, but the essential ones are still in there. So so we've just taken this one, Velocity Legal's one. Cover page is pretty straightforward. Homa Family Trust between I'm a Nugget and these people. So there is a contents page which tells you all the different clauses in the trust deed. So you might, with practice, you'll know where to go to look for particular things. For example,
Sometimes you just go to definitions. Yeah,
it's like definition, income of the trust, determination of net income. So you already know, like, this is telling you what you have to take up as your accounting income. This is what is for tax purposes, it's capital, trustee powers. So like Lisa just mentioned, this will list all the things trustee can do or can't do. Trustee liability, distribution. So if you have made some beneficiaries presently entitled, then how do you need to pay them if there are any prescribed methods? If you've got a guardian, so on and so forth, and blah, 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 blah. So let's just go through a couple of them. So this is either at the front or the end, depending on if you have a separate schedule as well. I think there is a schedule on this one too, but you can see that there are two parties. So I'm a Nugget. So my mouse is lagging a bit. Let's just go to the schedule, because I always look at the schedule first to make sure we've got all the parties, and make sure that the trust deed is executed. So just check that it is signed. If it's not signed, you call up the client and say, hey, can you give me the signed copy of the deed, please? And if they established a trust in a state that requires stamping, then what I used to also do was make sure a copy of the there's like an electronic stamping document is also
It's a page now.
trust deed.
It looks like a piece of parchment now. It's not a stamp. It used to be stamped.
Yeah. So if this was a new client and Homa or Marge sent this to us, we just make sure everything is all in order, because if it's not, then you've got to go back to them and ask for it. So
And then if you've got a copy, make sure you've got the signed, executed copy. The number of
Yeah.
times, the banks or something ask us for a executed copy and go, no, sorry, I've only got the unexecuted one. It's just good onboarding process.
Yeah. So I like it when they have schedules in this because this gives you the overview of everyone that you need.
Sure, it does, yeah.
It's like the TLDR.
I'm giving you a nice one.
Yeah. Some of them don't have schedules, so you have to like go into every clause and like check who the settlor was. And,
They're silent. They're really annoying when it's silent because you go, have I not found it? Or is it written somewhere that you don't know? If it's silent on things, you just go, oh no.
yeah.
Yeah.
So you'd rather get told what something is than have to guess in terms of trust. So you see when it was settled. So this was a few years ago already. You see the settlor was Amma Nugget, who just happens to be their accountant and Nugget tax advisors. So it's a very common scenario. And you see, how much did Amma Nugget give to settle this trust? $10, and it's probably stapled to the trustee to make sure it doesn't go into a deficit.
Yeah.
So trustee.
The financials as well. Yeah. Anyway.
Yes, so we'll check in the financials as well if there's information there. I find that it's often missed, same as in companies. People forget to take up the shares.
Emphasising things that are missed because that's
Yeah.
what you find and go, yeah. But it's just
Yeah.
sitting in the folder, in the permanent file.
Yep.
Yeah. Sorry, go.
No, all good. So trustees, we've got Homer and Marge. So we note that they are individuals. If this is a pretty old trust, just make sure they haven't changed the trustees, just in case they've decided to, change it to a corporate trustee, or Homer and Marge, I don't know, have passed away, or just decided to change out the trustees. Just make sure you've got the proper people in contact. Name of the trust, like Lisa said, it doesn't have to be unique. You can have multiple trusts of the same name with different client groups. It just might get a bit confusing when you're looking them up in the portal. Specified
clients do
beneficiaries. Homer and Marge, so you see that they're the specified beneficiaries, but there's also additional classes of beneficiaries. So this is just expanding on who could be considered as beneficiary for the trust. It's just like a shopping list of people: parents, brothers, sisters, spouses, widows, the kids, the cousins, like whoever's invited to the cookout, I guess. Any eligible corporation, any eligible trust, any charity, schools, universities, and so on and so forth. So some trust deeds might not allow distributions to charities, but if the trustee wants to do that, you might just need to amend certain things. Appointors, we mentioned as well, they're the kings and queens, the kingmakers, queenmakers. So Homer and Marge have to be those, just in case they're not the trustee. And if something happens to one of them, then just the other person just becomes the sole appointer. So that's cool. No guardian, so don't need to worry about that. The perpetuity period is 80 days, so that's the kind of time limit for this trust. Make note of that. It's 2094, probably won't be alive then, so maybe not our problem. And just make sure that you know the state that this trust is governed.
So therefore, I'm expecting a stamp duty, $200 stamp duty on that one.
So that's a quick overview, and we'll probably look at like the definitions of income and stuff like that on Thursday. But if you have a trust that you're already working on and you haven't looked at the trust deed already, I would highly recommend that you do look at it and make sure just give it a quick skim, look through the key clauses, especially in terms of distribution powers and trustee powers and things like that as well. Cool. All right, let's switch back to the slides so we can continue. If we've got more time, then I'm happy to go through the other documents.
Thanks, Vic. That was good.
Cool.
That was good to give them a bit of a taste. The other thing is like this, as I said, this is easy to read and they can do whatever they want. You go to there and you know roughly who's who at the zoo. You're pretty happy with it all. If you have inherited a trust deed where it is hard to read, get your trustee to go to a lawyer and get them to give you the summary version so you know what to do. Definition of income up to whatever you want. Get them to help you with it, okay? Because I am not, I can read trust deeds, but even I go, not sure. We better go to a lawyer and ask for that clause to make sure it's right. So old deeds have many amendments. Make sure you've got the amendments that you need. Make sure you're up to date with all the clauses. And make sure the resolution matches the deed. Okay, I know that a lot of practices have one size fits all. Oh, we've got a really lovely generic one, right? Or you go, I can read the trust deed. I'm going to do clause 5.6.3 is the definition definition of income, and I'm going to use that. What happens if it's not the definition of income? Maybe it's not an operating clause or something like that, right? So really watch out for that. So from my point of view, I like having some sort of template that helps the trustee that's been drawn up by the lawyer to say what they can do. Okay? So a lot of trustees should then come with, well, here's a resolution that you can use. Here's how you can distribute X, Y, and Z to A, B, and C. Okay? And it will use the right clauses. I don't like using clauses in trust resolutions because if you get it wrong, you might stuff up the present entitlement. And if you know what happens when you don't make someone presently entitled, the trustee's paying tax at 47 cents on the dollar. So it's a big issue to do. So don't try and be too clever, everyone. Please don't. You are not lawyers, I'm assuming, because you're doing this zero to many hero, and you're not experts at trusts. I'm always very cautious. I don't have clause numbers in any of my trust resolutions. Unless it's been drawn up by, I shouldn't say my trust resolutions, of any of my clients who's the trustee of trust resolutions. Okay? So just be very careful. And push it back on the trustee. Be very mindful if we do it, because our insurance will not cover us for legal advice. We've got a resolution in the pack, haven't we, Vicky, for this trust resolution?
For Thursday.
Yep. Yeah, for Thursday we'll do it. So make sure you check with resolutions. The terms of the deed, the definition of net income of the trust estate. Remember, that's the accounting. Sorry, that's the tax, I should say. Is it silent? Is it included? Is it excluded? Is it the same as tax? Is the beneficiary eligible? Okay? Are they in the suite? If you're distributing to a bucket company, was the bucket company incorporated by the 30th of June in the year giving the distribution? Have they made a family trust election because all of a sudden they're going to distribute it to the school or the Lost Dogs Home or something like that? Is there a written record of the streaming of capital gains and dividends? So we're allowed to stream those things for tax purposes, but the trustee still has to let you do it in the first place. Okay? The distribution wording should be clear and unambiguous as to the beneficiary entitlements. Okay? If you're going to be specific, make sure it's specifically correct. Otherwise, I'm very comfortable for you to be vague. So example, capital gain. Is it, Vicky, gross capital gain? Is it net capital gain? Even that. If I said I'm going to distribute the capital gain, I don't know whether it's net or gross if I just leave it like that. So then you've got a tax equalisation clause that we talked about. If you say capital gain, I'm distributing the capital gain to Vicky, guess what I'm distributing to her? Of the $100 I use an example, I'm only distributing the 50. So what happens to the other 50? You see what I mean? Just because you've got something that seems good, it's going to depend. And you're probably not going to have a capital gain every year for your client either. So again, have a look at what you did last year and go, okay, this is what happens this year, just don't roll forward. Other things to note, the HA will accept a resolution that's been made even if the records are created after 30 June, as long as the resolution has been validly made by the 30th of June. But how do you prove it if you haven't got that bit of paper, is my argument to everyone. I've got an email that says, have you considered it? And I'm going, yeah, and then you convert that into a resolution or a minute afterwards, I'm okay. But if you've just pulled it out of the air, who knows? You're allowed to make interim distributions throughout the year. You think about your client that pulls the money out of the bank account, we're all good, and we're going to true it up on 30 June. Again, doesn't need to be in writing, but again, how do you prove it? Documentation is the key for us now. With all the new TASA rules and things like that, we've got to document our little heart out, and even notice someone even put an AI note taker in this session. Because you got to use the tools to make it easier for us. So, I've been throwing the words around, Vicky, haven't I? resolution minute. You might see the words resolution used interchangeably through the client's distribution resolutions. Just think about it. Is one right, one wrong? Are they used interchangeably? Are we correct or not? If I just say the word minute, if I'm going to have a minute of a meeting, what sort of meeting do you usually talk about? You talk about a director's meeting, having a minute, and then you go and, okay, there's two different types of trustees, individuals and companies, can't there? Maybe that's the answer. A resolution is used when an individual trustee or a corporate trustee with a single director. Minutes is when you've got multiple individual trustees, or in the case of a corporate trustee, there's multiple directors who attend a meeting to decide the distributions for the year. Yeah? You call circular resolutions or whatever, I don't mind what you call them, but again, that's sort of how we use them interchangeably. We're usually pretty slack with that, but we know what it is. Okay, streaming. I did allude to this. I did look at streaming. Oh, didn't mention streaming. So let's just think about that. The trust is a flow-through entity. Okay? So everything retains its character. Streaming could be permitted for tax law, but you've got to make sure the trust deed allows for the trustees to make beneficiaries specifically entitled to a capital gain or a frank distribution. They're the two things we're allowed to stream. This is all streaming. Remember how I said if you want to be intelligent, just say, oh, that was in Bamford. You usually can get away with it. Anyway, so we can stream capital gains and frank distributions for tax purposes, but you better make sure your trust deed allows for that streaming provision in the first place. So the hierarchy is the trust deed and then all the rules on top of it, right? Same thing with an SMSF. You got the SMSF, you've got your tax rules, and then you've got your SIS Act and your SIS regulations on top of it. Because your SMSF is just another trust, another special type of trust. All right, so remember the hierarchy of what you need to look at. Because a lot of people say, oh, we're just going to stream. You go, but your trust deed doesn't let you do it. Well, you can't do it then. Remember, the rules of the trust deed. Beneficiaries must receive or have reasonable expect to receive an amount equivalent to the net beneficial benefit of a capital gain or a frank distribution they're entitled to. The net financial benefit must be referable to the capital gain or frank distribution, e.g. the franked distributions are traceable and expenses specified to the frank distributions derived or applied against the frank distribution income in the trust. Now, has a light bulb gone off yet for anyone that's filled it in? Remember how you've got to match it in the beneficiary statement? So it's going to match it. So if you've got income or dividend expenses in your trust, the net amount has to go. You can't split out the assessable and the deductible because it's connected. Alright, so that's what we're talking about. Same with the capital gain. Any expenses that would go to cost base, probably do that anyway, wouldn't it? I think frank distributions are a better example. So there's usually a clause in the trust deed that allows the trustee to record the character of the net financial benefit as a capital gain or a frank distribution. Frank distributions must be recorded by the end of the year. Capital gains must be recorded within 2 months after the end of the year. Why? Because sometimes you haven't done all the calculations. But in your resolution, you go 100% of the capital gain, 100% of the frank distributions. The frank distributions from BHP or NAB or whatever will go to someone. You can make your resolution and your minute as colourful as you like, but just make sure it's right. Okay? So that's how a streaming works. Next one. Family trust elections. Alright? Family trust elections, and I think we've got a Slido to start us off.
Yes.
Let's see if they're paying attention.
Alright, so QR code's on the screen, otherwise this isn't, I guess, popped a link in the chat as well if you are a super latecomer. I think this one is the second to last Slido of the day, so give it a go. I want my 50 responses again for this one. Question: have you made a family trust election for a discretionary trust by having a family trust in the trust name? Yes or no?
No, I'm expecting a 100% response.
This one better be 100%. 100%
I think I
correct,
mentioned
please.
it that many times at the beginning of the day. And we call them that, don't we? Discretionary trust, family trust. Most
Yeah.
people call them, oh, I've got a family trust, Lisa. Most people, clients say that to me. Got a family trust. They don't say I've got a discretionary trust.
But not always technically correct. That's the other clue. To get us at 100% correct.
They're asleep, Vicky. Come on. Chop chop, everyone.
We've got 20 minutes left as well.
20 minutes
Nice.
left.
Nice timing, yeah. Come on.
What's good? I gave him a bit of a chop chop. Maybe we've got a few more.
Yep. Alright, 5, 4, 3, 2, 1. Alright. Give it a free pass. Oh! What? Okay, so 2/3 of people got the right answer, which is no, and 1/3 got it wrong. So your discretionary trust doesn't become a family trust without doing the family trust election. That
Correct.
Yeah.
Like,
Yeah.
you could call it a family trust if it's all the family members. So it's sort
Yeah.
of like discretionary trust equals family trust. But you have to action a family trust election to get the benefit of it. Samir said we were all asleep. Yeah, that's right. I thought the question was straightforward. I don't think there was question in any ambiguity there, but anyway, we'll see how it goes. Yeah, so again, I'm not a big one, and we've probably got it on the slides anyway, but I'll say it now, that you don't just put a family trust election on discretionary trust because it's a family trust. Because it is restrictive. So there's pros and cons with everything in tax. There's a pro and con. You've got to work out if it's going to work out best for you. So let's have a chat about what is a family trust election. Okay. So the trustee is going to make a valid family trust election on an approved form that the trustee is considered a family trust for tax purposes. It could be a family trust for family purposes, but if you want it for tax purposes, you need to fill in an FTE. It's not sufficient just to put family trust in there and go, we're good. But make your family trust election. The trust must pass the family control test. A specified, I put the brackets text test in there because they use specified or test interchangeably in the legislation. I think they updated it a while back, but we're fine to use those interchangeably. Individual must be named. So you need a person. There can be only one person and they must be alive at the time of making the election is made because they've got to sign stuff. Okay? So you're going to have an individual that the family control test hinges around. Make sense? The commencement date must be specified. The income year must be ended before the FTT, the family trust election is made, and it can be backdated to 2004 as long as certain conditions are met. That during all that time, the family control test was passed. So if you're going to backdate it, you better make sure you've adhered to it. Yeah? And distributions have not been made outside the family group. Okay? So we're basically saying, yeah, you can, if you haven't done one and you're going, ooh, maybe we should have done one, you can backdate it, but you better make sure that the family trust election's been obeyed for that time. So again, think about it. You've got your trustee, you've got all your beneficiaries, then you're going to overlay the tax laws, and then you're going to restrict it further. So a pyramid going up to restriction, you're going to have a family trust election on it. So why would you do it? Because it sounds like I'm making this discretionary trust not as discretionary, Vicky.
yeah.
Isn't that what we're doing?
Defeating the purpose.
Yeah, because it's a discretionary trust. Are we defeating the purpose? So why would we make a family trust election? As I said, you don't have to make one just because you call your trust the family trust. Homar Family Trust has got a family trust election, but we did it specifically. Okay? love this idea of a discretionary trust. The trustee can, distribute to the dog, the family poodle. So what are the pros and cons? Trust loss measures. You know those tests that we talked about before that sounded a little bit complex and you went, ooh. You get concessional treatment. The family trust gets concessional treatment when applying the test for applying trust losses. Only a modified income injection test would apply. Because you think about some of the ones we talked, pattern distribution and things like that, we're already restricting the pattern to the family around the control test. So that's what you want to do. You go, I've got all these losses, let's whack a family trust selection on it, then I only have to make sure that I'm not doing anything mischievous with the losses by injecting some capital. I'm pretty cool with that. Again, that's why we only just touched on it, because if you're going to use losses, I'll whack one of these on to make it easier. I'm not going to trace it back to 2004. Franking credit holding rule. What are these? So unless beneficiaries have a vested and indefeasible interest to the shares that generate the income of the trust, they could be considered a qualified person for satisfying the holding period, the 45-day rule, as we call it. The franking credits would then be denied to the beneficiary. So there's a de minimis for this. So to be entitled to a franking credit, you've got to hold the shares at risk to receive the franking credit and the dividend. But who owns the shares in a family trust? The trustee. Who gets the dividend? One of the beneficiaries that you're going to stream it to. So the beneficiaries haven't received, have received the dividend and the franking credit, but are they entitled to it if they haven't actually held the share? The trustees held it on behalf of the trust. So this is where it overcomes those. There's the de minimis. So if you're going to distribute more than 5K, then you're going to put family trust election on there. So there's two main reasons I do it. One, they got losses, and I'm not going to fluff around with the pattern distribution test because it's all too hard. Secondly, the franking credit. So think about it. If you're going to pay a big dividend in from Boards by Bart, and then you're going to pass it out, and it's going to be more than $5,000, I think we need a family trust election on it. And that's a de minimis.
Yep.
Okay? So it's called the qualified person test or the 45-day rule test. No trust beneficiary reporting is required. Oh, I think Bradley put something in this. Are you going to talk about TB reporting? Because it's now become a hot topic. It's come through in my emails from a few saying, hey, the ATO is going to come down on you. Because usually we just go, just make the thing validate. We're not going to do TB reporting. So you don't need to do trust beneficiary reporting if you've got a family trust election on it. So Bradley, if you've got one of those, don't worry about it. But if you don't, you do need to do it. And you should be doing it. Right? I've got a unit trust where they distribute to a corporate beneficiary and someone else, and I've always done TB trust reporting. You just got to make sure you've got tax file numbers and things like that. It's pretty straightforward. It's not that hard, but you need to do it. Again, the ATO are coming right down on making sure that they can collect all the tax from the beneficiaries. Okay, so the data matching is all going to come through with trusts. Where previously they haven't been able to do that. Okay, so pros and cons. We've done the pros. That's why you'd want to do it. Don't put it on unless you want to use those things. The consequence for that is you cannot distribute beyond the family group. Otherwise, you know the tax rate, everyone. Rinse and repeat, 47% tax. The big penalty tax. Think about all those nasty things. Tax file number withholding, maximum. Family trust distribution tax, maximum. FBT, maximum. You get my drift. All the stick taxes to prevent you from doing it. Alright, so who's in the family group? There we go. There's our test individual. So you usually put someone in the sort of middle range of it all. Okay? So you've got 2 generations up. You've got everyone lineal descendant. You've got a few sideways, and the spouse's siblings. What stands out here to me, Vicky, is what? Where's the ex-spouse? There's no ex-spouse.
Not there.
Yeah, our ex-spouse.
They kicked out.
Yeah, so again, and I'll just reinforce it. A lot of these family trusts, discretionary trusts, have families that separate, goes to the family law courts. The judge goes, oh, the ex-wife can have the distribution for the next 10 years from this discretionary trust. It's got a family trust election on it. What's the word again? Hold on, let me get it. Family trust distribution tax. Yeah, sorry. FTD, but I knew my acronym I'd go around the wrong way, so I wanted to double check it. All right, so you're going to be up for that. Again, just be very wary. Remember even though they're lawyers, they're not tax lawyers. We know more than they do. Again, trust, different thing, but this sort of thing we do know. Okay, so what about an interposed entity election? Have we heard of those? Yeah, we have, haven't we? We've heard about those. So what are those? Can we distribute to a company, Vicky, that's in the family group? Because that test individual didn't have any companies attached to it. So this is what we have. We have an interposed entity election. So this is like a family trust election. Individuals, we're good. We know where the test individual is, and we know everyone blood related and lineally related and done by marriage. But this brings other entities to be part of the family group. They include companies, so bucket companies, so corporate beneficiaries, if you want me to call it that, partnerships and other trusts requiring to satisfy the family control test. So if they're controlled by the individual in that group, they can do that. Then you need to make an interposed entity election on that entity. Okay? So for an individual, we don't need to make the disclosure saying, hey, we're part of the family group because it's obvious. But if you want to use a corporate beneficiary, you will then have to put an interposed entity election on that entity to say, hey, this is controlled by Homer. That makes this Homer Proprietary Limited company part of the group. Yeah? So we can still distribute to bucket companies with the family trust election.
Oh, all right. Very last question for today. So let's get on to it. QR code's on the screen. Otherwise, this Nugget will pop the link in the chat. So give this one a go. Please get to my 50, not to spite me today. Question is, if the test individual dies, because like we mentioned before, when we're making the family trust election, they need to be alive because they got to, sign the FTE form.
Mm-hmm.
Do you need to change the test individual if they die? Yes or no? Interesting question.
Oh, it happened to me. I had to look it up. I went,
Oh, okay.
ooh. I onboarded a client.
Yep.
I went, good question. And I was
Yeah,
like,
I
I
know,
had
really
another
big.
one where an employee died, and they said, "Are they still got an FBT liability?" And I go, "Oh, good question."
And the answer was no, right? For that
Yeah,
one?
it dies with them. It's in the very. If
Yeah.
you pull up the FBT manual from the ATO, which is a beautiful document that's got everything you want to know about FBT, and I'm sure you've done that with Paul as well, Vicky. That document is just a beautiful document. Probably my second favourite one to the rental property, report as well. That one. The very first page says,
Yep. All right, looks like we're stuck because everyone is asleep. So let's see
That's all right.
what the correct answer is. No, you don't need to change it.
good. We got halfway. It was one of those fun ones. Well, you've got to watch, everyone. Just mindful. You don't change it. It can trigger resettlement sometimes if you do change it. So please, I've got a client in this case, the one that I looked it up, said, "Oh, that's my grandfather. He's died. Da 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 da. Let's change it." I go, "No, we're just going to leave it. Are you going to distribute outside the family group?" "No, we're going because remember you got all the lineal descendants anyway. So you're all good. You don't need to. They only have to sign the bit of paper to begin with, so they've got to be alive when you make it.
Yeah. Just be careful when you look at that family group tree as well. If you are going to have a family trust election and you're picking the person that you want as a specified or test individual, make sure you're on the correct level as well. Because I did have a client who made one and they made it their father, who had since passed away. But then they were like, oh, now it stuffs up the entirety of the other group, because actually they didn't want it to be at that level. They wanted to be like a level down, because then it restricts a bit more. Because the higher up you go, of course, all the descendants, it's going to widen the net.
Yeah. Again, it's one of those things you've got to be very, very careful with. All right, I think we've only got a couple more slides to go.
Yeah, 5 minutes. Yep.
Yeah, good. We're going for good for time. Excellent. So, can we change it? FTE IEE. A family trust election can be revoked for several reasons, including if the trust is a fixed trust or the FTE is not needed to assess certain benefits. Deducting losses or accessing the benefit of franking credits. I still don't like doing it, though. I'll leave it going. The specified individual of an FTE can be varied only once and only under certain conditions, including the new specified individual being a family member of the original specified individual. So you can't go having a blended family if that's the case, yeah?
Yep.
So for an interposed entity election, it can be immediately revoked if the FTE is revoked, because of course that's sort of linking, it's sort of the next step. And additionally, the interposed entity election may be revoked if the entity was a member of the family group or becomes one at a later point in time. So if the company changes hands, it's kicked out automatically, yeah? Makes sense. Okay. For both the family trust election and the interposed entity election, variations and revocations can be made until the end of the fourth income year from the income year specified in the original election. Okay, so we can do those sort of things. Again, I don't like doing it. Once it's on, it's on. You've just got to be really careful. And family trust elections, just like trust beneficiary statements, are starting to come under the scrutiny of the ATO. So just make sure you know what you're doing and why it's going to happen and all those sort of things. And if you want to find a family trust election, you can find it in the portal or in the online system for agents. Okay? So, if a tax return has been lodged without one, variation of the tax return cannot be amended to include it. You don't need to use the ATO form to make elections, variations, or verifications. You can use your software, but the form you do use must contain the same information specified in the ATO form, including a written declaration. So this is where we've got to, Vicky. I think we're finished roughly on time. So we've gone through and done most of the things we wanted to talk about, and I think it's left us for next week to make sure we give enough time to go through the trust return, but also important to revisit Homer and Marge's one once everything's flowed into it. Okay, so you put the poll up saying that you love us. Well, hopefully you love us anyway.
Hopefully. You can be honest. You don't have to lie just to make Lisa and I feel good.
Read them every night that we do them. We like giving those sort of things. So we've probably got a fair few questions that we can answer in a reasonable amount of. So let's go, Vicky. I'll leave it to you to drive the Q&As.
Yeah, so I did leave all the Q&A to the end because I really wanted us to get through all of the content, if possible, by the end of today's session, so that we could spend as much time as possible on Thursday just going into the documents, doing the tax reconciliation, because that actually took me a bit of time to remember how to do them, and also to do the tax return, which of course is a lot lengthier and there's a lot more disclosures as well to input compared to the partnerships and companies one. So there's going to be a big year and there's going to be a lot of documents, so hopefully everyone will be ready for that. All right, question number uno. Let's go backwards. So Carly's just asking a general question. Is it best practice to just not make a family trust election until you absolutely have to?
No, I concur, Carly, absolutely. You don't want to restrict the distribution. So the beauty of a discretionary trust is it's got absolute discretion, so to speak, right? Your trustee, especially the one that we've got for Homer, the trustee can do whatever it likes, really. It's given carte blanche. So don't put one on unless you have to, because you're then going to restrict the distributions. So only the losses and the franking credit. They're the only two reasons that I do it.
Yeah, yeah. Cool. Next question is from Sally. Ooh, so when we looked at the Homer Family Trust deed, we saw that there were specified beneficiaries, so they were just named Homer and Marge. Are they the same as the default beneficiaries?
No, they'll be different. So there's different classes of beneficiaries. The specified beneficiaries, and I haven't looked at the trustee, so I might be wrong, Vicky, but I've got a funny feeling they're the ones that get it on vesting. It might be. It just depends on how it's written. I haven't looked, but you'll find that the specified beneficiaries, that class of beneficiary, will be associated with some part of the trust. It will definitely say default, Sally, so that's what you want to look for. And again, I love default beneficiaries because it allows for any mistakes anyone makes.
Yeah. Awesome. Next question from Edward. Oh, this is a classic one. So, if you've got a new client and you find that the trust deed has not been stamped, but apparently it was settled in 2012, what should you do?
Well, if it should have been stamped, I'd go to a lawyer. It's, from my understanding, and as I said, I'm not a lawyer, it's got to do with stamp duty and things like that in terms of transfer of property. So you might be all right and be able to stamp it post, but if you're going to if it's been any transfer of property through it, I think you might be in a little spot of bother. So please go and talk to the lawyer. Is that your understanding as well, Vic? You've listened to a lot of other people talk about trusts.
I think I heard one time, this was like very, very long ago,
Yeah.
but someone told me it's like, if it's not stamped, it doesn't count. It doesn't exist. So then you run into all these other problems
Yeah, I think
with
you're
whether
okay.
it does actually exist or not.
Yeah, I think it's okay. It's to do with I think if it's not stamped, it's got issues when it's holding property, which usually trust deeds do. So keeping with what you've said, you're probably in a bit of trouble. Yeah, go see a lawyer. Yeah, a bit of a problem.
Yeah.
But again, and the same is as if you can't find a trust deed, please go and see a lawyer and work out what's going on. And as you can see, Velocity Legal, Andrew Henshaw and the team there have provided the sample for us. So go and see them, and they'll look after you or anyone else that's doing trust deeds.
Yeah. All right. Next question is from Sally, because I guess this goes in the. What if it goes in the vein of like family trust election? But she asked this question earlier. If you have multiple trusts that have the same corporate trustee and the same classes of beneficiaries, are they associated trusts? I've never heard of such a term. And can then a trust in this little group of associated trusts distribute a capital gain to another trust in this group with a capital loss to use it up?
It sounds like that's a bit like an income injection to me, and so and remember that's the only thing with a family trust election that you've got an issue with. But I don't think she's talking about family trust elections, isn't she? So no, they're treated just because you've got the same corporate trustee, they're still separate trusts.
Yeah, yeah.
No, because it's trust. It's streaming. I'm sorry, it's trust loss streaming. You're not allowed to do that. There's an integrity provision there. Stops you from doing that, otherwise you would all do that, cascading through.
Yep. Cool, thank you, Sally, for that question. Next one is from Prashant. So, if a trust does not have any net income for a financial year, so that's taxable income, can we submit a, like a return not necessary or non-lodgement advice? Or do we have to do a tax return, but it just is nil?
I do not like lodging return not necessaries because I like triggering the review period. So it is so much easier with your software to just roll it forward, everything's in there, and document it all. If you're saying that the trust is operated, you do a trust return. It's as simple as that, because you've done the financials and do the work. But even if you think that, I'm not going to do one, I know some people do it. I just don't think it's very good practice, and I actually think it's incorrect. Okay, if it's dormant, even if necessary. But if it's active and with a loss, you want to do that, and because you remember you're going to carry forward that loss till the next year, providing you meet the loss integrity provisions.
Yeah, I think it's just important to show that something has also happened in the trust, because even if it's like you end up having no assessable income or no income to distribute, if you still had a lot of income and a lot of expenses, you should still show that it's happened. I am also very against lodging a return on necessary unless there absolutely was nothing that happened in the trust that year. Like, for example, maybe it just got set up like in June or something, and you've only got the settled sum. Okay, cool. Then yeah, you can lodge your return on necessary. But otherwise, super, I would not recommend it, and it's not something I recommended in practice either.
Yeah, sometimes people don't like vesting the trusts as well, Big, and they just go, "Oh, we'll just leave it in perpetuity and just let it roll out," right? Because they've just basically taken everything out and gutted it, but they're not just going to invest it. People do return not necessaries. Then I still like triggering the review period. I really do.
Yeah. Okay, so hopefully that answers your question, Prashant. And that's just not specific to trust as well. I think it's also applies to companies, partnerships.
FBT. I'm a big FBT nil
Yes,
returner as
FBT.
well.
Even if your liability is zero,
Yeah,
do it.
I do a nil FBT return as well for most clients. Yep.
Yeah. All right. Last question is from Sally. If the trustee has paid tax at 47%, so don't know what's happened, but they've been liable for the tax, and then the income is distributed. Say the beneficiary's tax rate is obviously less than the 47%. Can the beneficiary claim a tax credit of the tax paid by the trustee?
That's a really good one. So, so you're saying that so the trustee has not made anyone presently entitled, or Section 100A applies. So therefore, of the $100, let's say there's $100 there, the trustee pays the tax, 47, so there's 53 left in the trust. Everyone following the bouncing ball? Okay? There is no franking account in a trust. Remember, franking accounts are just for companies. So you can't attach a franking credit to it because it doesn't exist, right? But what is that now? The tax is being paid at 47 cents, so there's $53 in the trust. What is sitting there? Because it's not net income of the trust estate anymore, right? It's basically sitting in there. And it's really sitting in there as corpus. All right, so you need to read the deed to work out how you can distribute the corpus, or the capital, if you want to think about it like that, the corpus in the trust. You've got to work out who you can get that out to. And in a trustee like ours, I think you can distribute it to whoever you like. But it's actually non-assessable, non-exempt income, isn't it? Because it's already been taxed to the full tilt. So an excellent question. So there's no top-up tax because it's basically all the tax has already been paid on it. So you're just distributing out the accounting corpus, if that makes sense to you. All right? So that's what you're doing. Now, we've got a couple of minutes and people have hung on to this. I am finding that what people are doing with this, if you can follow me, because we did talk about 293 tax, didn't we? So, with 293 tax, just follow the bouncing ball because we've got a couple of minutes, right? With 293 tax, if your adjustment taxable income, for want of a better term, is above 250, you've got to pay that top-up tax on the super contributions. So if you get a distribution from a trust, you're already in the highest tax bracket at that stage. The distribution from the trust could trigger 293 tax on top of it, so you're paying a whack load of tax. Very scientific word, that very technical word. You're paying an absolute monty of tax on it. What some people are doing is doing that if they can distribute the corpus, because it doesn't trigger 293 tax, but they can still get it out as non-assessable, non-exempt. So hopefully you followed that, but that's what a lot of techniques I'm seeing with trusts now going, the trustee can pay the tax at 47 cents. Great. I'm still going to get it out at the same tax rate as what I'm going to pay anyway, 45 plus the Medicare levy, because I'm on more than 190,000, right? Anyone who's going to trigger 293 tax is going to be on more than 190 because it's going to be 250, okay? And then it's not going to trigger 293 tax. Interesting, isn't it? A few little techniques that we've talked about with that, but a really good question because it highlights a lot of issues with trust. Doesn't have a franking account, so what happens? And remember that 47 cents can happen, 47% can happen if there's no present entitlement, or if your trust says that that distribution is a reimbursement agreement under Section 100A. So again, you can make it work for you. Well done, Sally. Really good question.
Yeah, the other situations I think I can think of that we talked about today as well. So, for example, if it's a non-resident, if you distribute to a non-resident with the trustee, also again have to pay it on behalf of them first, and then the non-resident, if their tax rate is below the 47% or 45%.
Yeah, but the non-resident with paying tax at 32.5 or something like that.
Yeah.
It's not that high. It kicks in a what? When does non-resident rates kick in? I think it's round about the same. But remember, they're paying 32.5 on smaller amounts.
Yeah, but do they get a refund of the difference?
Oh, if it goes to a non-resident, because it's like a withholding tax.
Yes.
It's not a final tax, okay? But it's like a withholding tax. So it's like I'll pay tax at 32.5 cents in the dollar. But the trick with that one, Vicky, if I can just go a step further as well, is the trustee has to pay it before the individual non-resident gets to use it. So there's always a delay. There's always a bit of a mishmash. I've got one client that's in that category, and I put the tax return in hoping they'd let it through, but of course they didn't.
Okay.
And so I had to wait. So if you're in that situation, try and do the trust return as early as possible, because the ATO then have to assess it, give you the notice of assessment to pay it. Then you get a beneficiary account to the beneficiary that's the non-resident in the trust portal, right? Then you've got to pay it, and then they can use it. So sometimes it's delayed. But what was really nice was it ended up making the so what happened is I lodged without the credit in there, and there was a lot of GAC and all this sort of stuff in there, as you can imagine, because we didn't pay it because we knew we'd be able to get it back eventually. When I finally lodged the amended return, there was 2 trusts this individual was getting, so I actually had 2 amended assessments to pick it up as it all got paid, because the ATO took ages to do the notice of assessment. And then automatically, can you believe this? Automatically the ATO remitted all the GIC and all that sort of stuff without even me have to do it, and I've gone, oh, that saved a phone call.
Yeah. Phone call
really
or
good.
online
Watch it.
message. Yeah.
Yeah. Oh, good.
Awesome, cool. So we'll wrap it up there. All right, as you know, Lisa, what is your key takeaway for today's session?
I'm hoping that the key takeaway for everyone is fundamentally understands how trust works. Don't just rinse and repeat and roll it forward without actually understanding it. Because trusts are now very much on the scrutiny of the ATO, so it's really important that you understand what you're doing. All right, so if you can fundamentally understand what you're doing, and in doing that, make sure you educate the trustee of the trust. I find that in doing that, we take on too much responsibility. If your client has a trust, make sure they know what the responsibility is of the trustee. Because usually your client is the trustee in some capacity, director, shareholder, or individual. Make sure they know what their responsibilities are. Exactly the same as if you've got an SMSF. Make sure they understand what their role as being the trustee and the member of the fund all sort of fits together. So again, we have a big education for yourselves and for your clients in this area. Your turn, Vic.
Oh, what's my key takeaway? My key takeaway is read the deed, which is the classic one that we're always yelling. I know.
It's nice that it rhymes, isn't it?
Yeah. Read the deed. It's a very good chart, but it's very important to read the deed. I think a lot of...
Understand it. And if you don't
understand it, don't get it.
Yeah. Right?
Yeah,
and
get someone to explain
trust law. That's why we go talk to Andrew at Velocity Legal or whatever and say, explain this to me. No.
Yeah.
I said to him, Andrew, just a quick one. Explain defaults in Section 100A. And so we had a bit of a 10-minute discussion on it. And I go, thanks, now I understand it. It was great. Right? Because it's very technical. I don't like reading the 36 Act either.
Yeah. So, my key takeaway is just read the deed for any client that you have. I think it's just important to through it, especially next week when we do the tax planning bit. You do need to know what the rules are before you play the game in terms of trust.
Always a good idea. Excellent. Well, thanks everyone.
Awesome.
Thanks for being here. Hopefully you learnt a lot with Trust 101. So that's the last bit of our real technical heavy tax content as well, Vic. So Thursday, Vicky is going to beam in after a fantastic ABE session tomorrow. In
I'm not talking.
Hey?
I'm not talking. I'm just sharing the tax stream on day one. Yeah. So if anyone is
Still
in Sydney,
going
then,
to be there, so go and visit her if you're in Sydney and going to ABE. Please enjoy it. And then we'll go through, it's going to be the machinations of it all, and we'll highlight a lot of the things as we go through, and we'll look at how these trusts work and give you a few more tricks and traps on managed investment trusts and things like that. So thanks everyone.
Yeah. Awesome. Thanks everyone for holding on today and squeezing your brain juices very hard. Really appreciate your participation as well. And we'll see you on Thursday for the practical session on this trust unit.
Excellent. Cheers.
Bye Lisa. Bye everyone.
Hey Vicky.
Bye.
Safe travels.
Vâng, báo chị ra.
Ừ.